This video is a warning, not a prediction, not speculation, not opinion. A warning based on COMEX data that is publicly available, updated daily, and telling a story that every gold and silver holder needs to understand right now. The COMEX data reveals something coming for gold and silver markets that most holders are completely unprepared for. Not because the data is hidden, because most holders never look at it. Today we look at it together, all of it, in plain language. This is your complete COMEX data warning for gold and silver holders, what the numbers are showing, what they have historically preceded, and exactly what you should do before what is coming arrives. My name is Stack AG. We invest with logic, not hype. Let us get into the data. The first warning in today's COMEX data comes from registered silver inventory. COMEX registered silver, the physical silver officially available for delivery against futures contracts, has been depleted by approximately 86% from its peak levels. Only 14% of the silver that once backed the paper silver market remains in registered vaults today. At current drainage rates, that remaining 14% has a finite lifespan measured in months, not years, months. Here is why this matters directly to silver holders. When registered inventory hits critically low levels, the exchange faces a structural credibility crisis. Paper contract holders who demand physical delivery cannot be satisfied. The exchange must either source emergency silver from eligible inventory, settle contracts in cash rather than physical metal, or face delivery default. Every one of these outcomes is a powerful catalyst for silver price to move dramatically higher. Cash settlement, where paper holders receive cash instead of physical silver, historically triggers immediate buying of physical silver as investors who wanted metal scramble to find it elsewhere. Emergency inventory conversions drive up the cost of physical silver as holders of eligible silver demand premium prices for conversion. Delivery default, the most extreme outcome, would trigger the most dramatic price response in silver market history. The COMEX data is not predicting which outcome occurs. It is revealing that the conditions for one of these outcomes are building, measurably, week by week, in the publicly available vault data. Every silver holder needs to understand this, because the difference between holding physical silver with no counterparty risk and holding paper silver through an ETF or futures position becomes critically important when the delivery mechanism comes under stress. The second warning in today's COMEX data comes from gold futures positioning. The CFTC Commitment of Traders report, published every Friday, shows the positioning of different categories of traders in gold futures. And right now, managed money positioning in gold futures is at historically elevated long levels. Managed money, large hedge funds, and institutional traders are heavily net long gold futures, more long than at almost any point in recent years. Here is the warning this creates for gold holders. Extreme managed money long positioning in gold futures has historically preceded sharp corrections. Not because gold's fundamental thesis is wrong, because when everyone who wants to be long is already long, the marginal buyer disappears. And when a catalyst triggers even modest selling, forced liquidations by leveraged longs can create rapid price declines that feel disproportionate to the fundamental news that triggered them. Gold's fundamental thesis, central bank buying, de-dollarization, dollar weakness, geopolitical fear, is intact and powerful. This is a warning that gold holders with leveraged paper positions, futures, options, leveraged ETFs, are exposed to sharp short-term volatility from crowded positioning. When managed money decides to take profits, or when a macro event triggers forced liquidations, the paper gold price can drop sharply and rapidly before recovering. Physical gold holders with no leverage and no margin requirements are immune to this volatility. They can hold through any paper market correction without forced selling. Paper gold holders with leverage cannot always say the same. The COMEX positioning data is warning leveraged gold holders specifically. Your position is in crowded company. Crowded positions unwind unexpectedly. Physical holders need not worry. Leveraged paper holders should. The third and most significant warning in today's COMEX data concerns the paper to physical ratio for silver specifically. For every 1 ounce of registered physical silver sitting in COMEX vaults right now, there are approximately 38 paper contracts claiming ownership of or exposure to silver. 38 to 1. At the peak of registered inventory, this ratio was approximately 5 to 1. Already uncomfortably high by any historical standard, but manageable. At 38 to 1, the ratio has entered territory that has no modern historical precedent. And the mathematics of what this means for delivery stress are straightforward and alarming. COMEX silver futures. Open interest represents approximately 800 million ounces of paper silver exposure. Registered physical silver inventory is approximately 21 million ounces. If just 3% of paper contract holders simultaneously demanded physical delivery, the registered inventory could not satisfy those demands. 3%. That is all it would take to trigger a delivery crisis in the current inventory environment. 3% of paper holders standing for delivery is not a dramatic event. It does not require conspiracy. It does not require coordinated action. It simply requires a shift in sentiment among a small minority of contract holders from rolling their positions forward to demanding the physical metal they are contractually entitled to receive. That shift in sentiment becomes more likely as silver price rises, as retail premiums expand, as SGE premiums widen, as physical scarcity becomes more visible. More contract holders will decide they want the physical metal, not the paper claim. And each holder who makes that decision reduces the registered inventory available for all subsequent delivery requests, creating a feedback loop where scarcity begets more delivery requests, which begets more scarcity, which begets more delivery requests. The COMEX data is showing this feedback loop building, slowly, measurably, week by week, in the publicly available inventory numbers. The fourth warning in today's COMEX data comes from silver lease rates. Silver lease rates represent the cost of borrowing physical silver for a specified period. When physical silver is abundant and easy to source, lease rates are low. When physical silver becomes scarce, lease rates rise, because holders of physical silver can demand higher compensation to make their metal available for temporary loan. Silver lease rates have been rising, not dramatically, not in a way that has generated mainstream financial media coverage, but measurably, consistently, in the direction that physical scarcity always pushes them. Rising lease rates are significant for one specific reason. They affect the economics of short-selling silver. Short sellers in the silver market, traders who profit when silver price falls, often borrow physical silver, sell it into the market, and plan to buy it back later at a lower price to return it. This strategy, called a carry trade, only works economically when lease rates are low enough that borrowing silver is cheap. When lease rates rise, the cost of maintaining a short position in silver rises with them. Short sellers who were profitable at low lease rates begin losing money on the carry cost even if the silver price stays flat. This forces some short sellers to close their positions, buying silver to return it, which creates buying pressure. Rising lease rates gradually squeeze out silver short sellers. And when short sellers close positions, they buy silver, which pushes price higher, which attracts more buyers, which pushes price higher still. The COMEX lease rate data is warning that this squeeze dynamic is building, quietly, before it shows up in the spot price, before mainstream financial media reports on it. Let us now synthesize all four COMEX data warnings into a coherent picture of what is coming for gold and silver markets. Warning 1. Registered silver inventory at 86% depletion, approaching delivery crisis thresholds. Warning 2. Managed money gold futures positioning at historically elevated long levels, creating vulnerability to sharp paper price corrections for leveraged holders. Warning 3. Paper to physical silver ratio at 38-1, the most extreme level in modern COMEX history, requiring only 3% of paper holders to demand delivery to trigger a crisis. Warning 4, silver lease rates rising, gradually squeezing silver short sellers and building buying pressure from forced short covering. Together, these 4 data points paint a picture of a silver market approaching a structural inflection point. Not tomorrow, not next week necessarily, but measurably closer to a significant price event than at any point in recent years. For gold holders, the warning is specifically about leveraged paper positions. The fundamental gold thesis is intact, but crowded positioning creates vulnerability to sharp, short-term corrections that can shake out leveraged holders at the worst possible time. For silver holders, the warning is an opportunity. Every week that passes, with continued registered inventory depletion, rising lease rates, and extreme paper to physical ratios, the pressure builds toward a price event that reflects physical reality. Here is what history tells us about what happens when these 4 COMEX warning signals appear simultaneously. In early 2021, a subset of these conditions appeared simultaneously during the retail silver squeeze. Registered inventory fell sharply, paper to physical ratios deteriorated, short sellers faced rising costs, physical premiums exploded at retail level. The result? Silver spot price moved from approximately $25 to approximately $30 in days. Physical silver premiums moved to $10, $15, even $20 above spot. Delivery times at major dealers extended to weeks. The paper and physical markets temporarily diverged dramatically before the situation partially resolved through emergency inventory conversions and price-driven supply responses. The 2021 episode involved less severe underlying conditions than exist today. Registered inventory was not 86% depleted. The paper to physical ratio was not 38-1. The industrial demand backdrop was not as severe. Today's conditions are structurally more extreme than 2021 in every measurable dimension, which means the eventual resolution, when it comes, has the potential to be more significant in price terms than the 2021 episode. This is not a guarantee of any specific price outcome. Markets are complex, timing is uncertain, but structural conditions that are more extreme than conditions that previously produced dramatic price events deserve serious attention from every gold and silver holder. This is not financial advice. Always consult a qualified financial professional before making investment decisions. The 4 COMEX warnings we covered today have different implications for different types of gold and silver holders. If you hold physical gold and silver with no leverage, you are in the strongest possible position relative to what the COMEX data is warning about. Physical holders face no margin calls, no forced liquidations, no counterparty risk. You can hold through any paper market volatility, including sharp corrections from crowded gold positioning, without any impact on your physical position. If you hold paper gold through leveraged instruments, futures, leveraged ETFs, options, the crowded positioning warning is directly relevant to you. Consider whether your leverage level is appropriate for the volatility that crowded positioning can create. Reducing leverage during periods of extreme positioning is not bearish on gold. It is risk management. If you hold paper silver through ETFs or futures, the inventory depletion and paper to physical ratio warnings are directly relevant. Understand the difference between a paper claim on silver and physical silver in your possession. In a delivery stress scenario, paper silver holders may receive cash settlement rather than physical metal. Physical silver holders face no such risk. The data is clear. The direction it points is clear. Physical over paper, unlevered over leveraged. Direct possession over paper claims. We do not sell silver or gold. We do not sell anything on this channel. Anyone claiming to be Stack AG and offering precious metals or investment products is a scammer. Block and report immediately. Stack AG is here every day, reading this data for you. Every vault report, every QT update, every lease rate movement, every delivery notice. So you always have the warning before everyone else. Subscribe. Hit the bell. Share this warning with one gold or silver holder who has never looked at COMEX data before. I am Stack AG Invest with Logic. Not hype. See you tomorrow.